An annuity is an insurance product that helps turn your assets into income. It's designed to help convert your savings into a stream of income, helping to make your financial plans during retirement more predictable. An annuity is a contract between you and an insurance company. You make a lump sum payment or give the carrier a series of premiums, and in return, you obtain regular payments at some point in the future. The goal of annuity is to secure a steady stream of supplementary income in retirement. The annuity's interest accrues on a tax-deferred basis. The benefits of an annuity can vary greatly based on the features of the particular contract you choose. Many annuities offer additional benefits or riders that can be included in the contract or available for an extra annual fee. Common benefits of an annuity are building your retirement savings on a tax-deferred basis, catching up on your retirement savings through contributions not subject to the IRS annual limits of an IRA, leaving a legacy for your loved ones with various death benefit features, and receiving guaranteed income payments for the rest of your life. Annuities are designed for long-term financial planning. You can withdraw money from your annuity at any time, however. There may be charges and fees that apply. Your insurance carrier will provide you with an annual statement after each contract anniversary. The annual statement will show you the amount of any interest, withdrawals, fees, contract values, and other important information about your annuity and its benefit as of the anniversary date. Fixed index annuities offer additional benefits and protections. To learn more, watch our next section. But first, test your knowledge with a quick one-question quiz. A fixed index annuity is a tax-deferred accumulation product offered by an insurance company. It provides principal protection in a down market and still gives the owner an opportunity to earn interest on their contract value when the market goes up. These benefits are provided by the indexed accounts offered on a fixed indexed annuity. Interest earned on an indexed account is based on the performance of a stock market index, such as the S&P 500. The interest an insurance carrier credits on each indexed account is based on the change in the index value over a specific period. So for example, monthly, annually, or even over a multi-year period. While the indexed account does follow the market, your money is never directly exposed to the stock market. So what happens if the index value declines? At age 30, a market loss can have a big impact on a 401k balance, but it's not catastrophic. That person has many years to wait before a market recovery can get them back to where they want to be. Once in retirement, however, a large loss can have a meaningful impact on financial plans. Generally, a fixed index annuity protects the owner from direct market loss by simply crediting no interest on that indexed account for that period. This means that the value of your annuity does not decline when the market goes down. Now, it is important to understand that any contract fees will still be charged even when no interest is credited. Most fixed indexed annuities also offer a fixed account, which earns a specified rate of interest and is not based on the performance of the stock market. This rate may change annually and will be no less than a minimum guaranteed rate of interest specified in your contract. You choose how you want to allocate your contract value among the indexed accounts and fixed account. You choose your account allocations when you apply for the contract and may change your allocations on contract anniversary. You may choose to allocate to more than one account. Can you change your mind about purchasing an FIA and get your money back? Watch the next section to find out more. But first, test your knowledge with a quick 2-question quiz. Can you change your mind about purchasing an annuity and get a refund? During the free look period, you can change your mind without penalty. Depending on the state in which you live, you will generally have between 10 and 45 days. In some instances, you could have even more time. During that period, you can notify the insurance carrier that you want your money back without incurring any surrender charges, market value adjustments, or fees. The free look period starts once you receive your contract. Use this time carefully to review the terms of your annuity contract. Once the free look period expires, any withdrawals in excess of what the contract permits will generally be subject to penalties such as surrender charges and market value adjustments. Insurance carriers incur expenses from processing your contract and allocating your money in long-term duration assets. So this gives them protection, which enables them to offer you the primary benefits of annuities. Now that you've decided to keep the annuity, how will your contract grow in value? Watch the next section to find out. But first, test your knowledge with a quick one-question quiz.
Contract value is the value of your annuity contract at a specific point in time. When an annuity contract is issued, the contract value will equal your premium. Some contracts may include a premium bonus, which may increase your contract value at issue or over a certain number of years. Any additional premium payments will also increase your contract value. A fixed indexed annuity's contract value will grow due to interest. Interest credited on the fixed account may be credited as frequently as daily. Interest credited on indexed accounts occurs at the end of each crediting period. These periods are sometimes called segments. Segments may be 1 year or multiple years in length. At Nassau, our products generally have 1, 2, and 3-year segments for crediting interest. Fixed indexed annuities credit interest to your indexed account using a formula that is based on changes in the value of an index. The formula determines the additional interest you get, and when you get it depends on the features of your particular annuity. What happens if the market goes up quickly after you purchase your annuity? How can your accounts grow? Watch the next section to find out. But first, let's test your knowledge with a quick one-question quiz. In exchange for providing downside protection on indexed accounts, an insurance carrier limits some of the upside potential should the market grow. Generally, insurance companies limit growth through 3 levers: cap rates, participation rates, or spreads. A strategy fee may also apply. Let's take a look at each of these terms. A cap rate or index cap is the maximum possible interest rate that can be applied to your indexed account. For example, if the index grows 10% during a crediting period and the cap rate is 6%, your indexed account will be credited 6%. A participation rate is a percentage applied to index performance. In other words, the percent of the index growth experienced will be applied to your indexed account. If the index grows 10% and the participation rate is 50%, your indexed account will be credited 5%. 10% index growth multiplied by 50% participation rate equals 5% interest credited. A spread rate is the percentage that will be subtracted from the growth of an index. If the index grows 10% and the spread rate is 3%, your indexed account will be credited 7%. 10% index growth less 3% spread equals 7% interest credited. Some indexed accounts may have a strategy fee. A strategy fee is the percentage paid on certain indexed accounts. Accounts with strategy fees may offer higher cap or participation rates than accounts without a strategy fee, which means that it is possible to have a higher return than an indexed account without a strategy fee. It is important to know that your contract value may decrease if the indexed account earns less interest than the amount of strategy fee assessed. Generally, the fee is assessed when the segment matures. Cap rates, participation rates, spreads, and strategy fees are set at the beginning of each segment and may change for future segments. This means that the rates and fees applicable to the accounts you choose when purchasing your contract may change after the segments you selected mature. So you now understand how you will see your account grow. How do you take money out of your account when you need it? We'll answer that question in the next section. But first, let's test your knowledge with a quick 2-question quiz.
Life is full of surprises, and you may need or want to access the money in your account earlier than expected. You can withdraw money from your annuity at any time. It's important to note, however, that withdrawing money from your annuity before the surrender charge period ends may result in surrender charges, a negative or positive market value adjustment, or MVA, prorated fees, and less interest credited to your contract. You may withdraw the contract in its entirety, which is called a full surrender. The amount that you receive upon full surrender is known as the cash surrender value and is net of these charges and adjustments. The money available from your annuity as a full surrender, as a death benefit, and upon annuitization will never be less than the guaranteed amount described in your contract. At Nassau, this guaranteed amount is referred to as the total guaranteed value, or TGV. Any withdrawal taken from your contract will reduce the TGV dollar for dollar by the amount of net withdrawal. This amount may be less than the initial premium paid. What does it mean to incur surrender charges? We'll explain how surrender charges are determined in the next section. But first, test your knowledge with a quick 1-question quiz. Surrender charges are assessed if you choose to take a withdrawal in excess of any free withdrawal amount provided by your contract. The free withdrawal amount is generally an amount you may withdraw from your annuity contract each year without incurring any charges or adjustments. Surrender charges are typically expressed as a percentage of your premium or contract value withdrawn. In general, surrender charges only apply to an annuity for a certain number of years after issue, such as 5 or 10 years. This is known as the surrender charge period. No surrender charges are assessed after the surrender charge period ends. What if interest rates have changed dramatically from when I go to withdraw money from my account? We'll explain how current market conditions can affect how much money you can withdraw in the next section. But first, test your knowledge with a quick 1-question quiz.
Many annuity contracts contain an adjustment for changes in market conditions that applies when you withdraw money. A market value adjustment, or MVA, is an increase or decrease in the amount of money you receive when you take a withdrawal in excess of the free withdrawal amount or fully surrender your contract. The free withdrawal amount is typically a percentage of contract value you may take each contract year without incurring any charges or adjustments. An MVA typically applies during the surrender charge period. Most insurance carriers waive the MVA when death benefits are paid or when you annuitize your contract. The market value adjustment is applied in addition to any surrender charges. An interest rate, treasury rate, or index performance may be used to determine the value of the MVA and is described in your contract. In general, if rates are lower at the time of withdrawal than they were at date of contract issue, then the MVA will be positive, resulting in an increase to the dollar amount withdrawn. If rates are higher at the time of withdrawal than they were at the date of contract issue, then the MVA will be negative, resulting in a decrease to the dollar amount withdrawn. The amount of MVA is limited so that the amount of money you would receive upon full surrender is never less than your total guaranteed value. Likewise, the amount of MVA that would be added to the amount of money that would be received upon full surrender is generally limited by the same amount. Are there ways that you can withdraw money without any type of penalty? Yes, there are, and we'll cover them in the next section. But first, test your knowledge with a quick 1-question quiz. Insurance carriers have a number of different provisions that allow for withdrawal without penalty. You should read your provisions in your contract to be certain of the specific circumstances. Common options to withdraw without penalty include any amount permitted under the annual free withdrawal amount benefit, a required minimum distribution requested after the first calendar year, income benefits provided by a lifetime income rider, and by annuitizing your contract. When you reach the age of 72, the IRS requires that you start taking distributions from your tax-deferred savings plan. How does that happen if you own an annuity? We'll cover that in the next section. But first, test your knowledge in a quick one-question quiz. If you have a tax-deferred savings plan, you should consider how required minimum distributions, or RMDs, fit into your retirement withdrawal strategy. That's because, upon reaching the age of 72, the IRS requires that you withdraw at least a minimum amount each year from your IRA and your retirement plans, except for Roth IRAs, and that you pay ordinary income taxes on the taxable portion of your withdrawal. The amount you must withdraw depends on the total across all of your tax-deferred savings plans. However, you can choose whether you want to take the full required minimum distribution from a single policy or from multiple policies. The tax rules that apply to annuity contracts are complex. Individuals should seek independent tax advice based on their own circumstances. The company does not offer legal or tax advice. Each year, your insurance carrier will provide you with an estimate of the RMD you must withdraw based on the contract value and the rider benefits provided by your specific annuity. Most insurance carriers provide an option for systematic withdrawals of the RMD amount from your annuity. How do you set up your annuity to start giving you regular payments? We'll cover that in the next section. But first, test your knowledge with a quick one-question quiz.
Annuities offer 3 different methods for converting the contract value into income. They are traditional annuitization, automatic withdrawals, and the election of guaranteed income riders. All annuities can be annuitized, meaning they can be converted into periodic income payments. Annuitizing may provide the highest lifetime income amount out of these 3 methods. In exchange for this higher benefit, the contract will generally no longer have any cash surrender value once you annuitize. The earlier you annuitize and the more beneficiaries, the lower the periodic amount paid out will be. Some annuities may specify the date on which the policy can be annuitized, while others may have a flexible date. Different annuity payment options may be available, such as lifetime payment or payments for a certain period of time. You can also set up automatic withdrawals. With this method, you could choose the amount and number of payments you want to receive. This method is not guaranteed to last a lifetime. It is dependent on the amount of money in your annuity. Payments stop once the contract value has been depleted. This method can be used to set up automatic withdrawals and required minimum distributions. Finally, you can elect to use a rider that guarantees a specific amount of income for your entire lifetime, even if your contract value has been depleted. In general, you may start receiving your income benefit at any time. However, some riders may only provide an income benefit once you've reached a certain age or your contract has passed a certain anniversary. There may be an additional fee for this rider. Now, you'll understand the various ways to take money out of your annuity. But how much money will it pay each year or month? We'll cover that in the next section, but first, test your knowledge with this quick one-question quiz. The amount of income you receive depends on the specific terms of any annuitization benefit or guaranteed income rider. If you choose to annuitize the contract, the income is generally calculated based on the age and sex of the annuitant or annuitants and the particular payment option you select. Payment options may include income for a specified period of time, income for life, or a combination of both. If you choose to activate the guaranteed income rider, The income is generally calculated based on the amount known as the benefit base, and a benefit percentage based on your current age for a single life option, or you or your spouse's current age for a spousal life option. Income is generally a fixed amount payable each contract year. Some guaranteed income riders may provide income that increases each contract year. In addition, some fixed indexed annuities may also offer a higher income payment for a limited time if you are unable to perform at least 2 activities of daily living or are living in a nursing home. This benefit may be available for an additional fee. So how does your benefit base grow? We'll cover that in the next section. But first, let's test your knowledge with a quick one-question quiz.
Your benefit base is the value used to determine the amount of income provided by a guaranteed income rider. The benefit base is used solely for the determination of income and is not available for withdrawal. Your benefit base is equal to your premium at the time your annuity contract is issued. Some guaranteed income riders may include a bonus that increases the value of your benefit base. After issue, the benefit base may increase by a specified rate each year, such as growing at 5% interest. This rate could be compound or simple interest. The benefit base may also increase based on the interest earned on the annuity. Generally, these increases only apply for a certain number of years and may stop when you begin taking income payments. It is important to know that taking any type of withdrawal other than your income payment amount may reduce your benefit base, and therefore reduce the amount of your future income payments. The way the benefit base grows may differ from insurance carrier to carrier. To learn more about a specific income rider, talk to your financial advisor or review your contract for more specific details. So, how do you start the process of receiving payments? We'll cover that in the next section. But first, let's test your knowledge with a quick one-question quiz. In general, you choose the date the guaranteed lifetime income payments provided by your guaranteed income rider begin. This is known as exercising your rider. Once you have exercised your rider, you may choose to take automatic withdrawals of the income payments provided by your rider. Income payments will reduce your contract value, but you will not incur any charges or adjustments on these withdrawals. Though an exception to this is if your total withdrawals in any policy year exceed the income payment or free withdrawal amount, whichever is greater. Even after your contract value is depleted, you will continue to receive income payments provided by the rider for as long as you live. With a spousal income rider, you will continue to receive income payments provided by the rider as long as at least one spouse is alive. What happens to my annuity contract when I die? Find out in the next section. But first, let's test your knowledge with a quick one-question quiz.
With a fixed indexed annuity, you determine who receives the death benefit by designating beneficiaries when you purchase the contract. That person or persons, who could be a spouse, child, or other loved one, will be able to receive benefits after you die. In general, the death benefit is equal to the greater of the contract value or the total guaranteed value as of the date of death. This means that no surrender charge or market value adjustment will apply. Some fixed indexed annuities may offer a rider that can provide a higher death benefit than the contract death benefit for an additional fee. What happens if your spouse needs access to the income or cash value after you die? We'll explain how this is handled in the next section. But first, test your knowledge with a quick one-question quiz. Some annuities allow your spouse to continue the contract as the new owner instead of receiving the death benefit as long as they are your beneficiary. The Internal Revenue Code has distribution at death requirements that may affect the terms of the contract upon spousal continuation. These are described in your annuity contract and are based on the death of the owner unless the contract is owned by a trust. For more information about these requirements, consult your tax advisor or financial representative. Let's test your knowledge with a final quick one-question quiz.